Our next guest pulled no punches responding to those comments, taking to Twitter with some choice words, as you can see here. Northman Trader founder and lead market strategist Sven Henrich joins us today. As the market has definitely come to you, Sven, over time, what happens now, and how does it change your forward view?
Hi, Carl. Good to be with you. Yeah, I mean, look, just regarding that comment, the Fed spent a lot of time last year actually explicitly saying that they want to avoid a taper tantrum, which was, of course, in reference to what happened in 2013, which was specifically outlook on the stock market. And now to pretend that they're not looking at the stock market is a bit rich. In terms of where we are now, obviously a massive bear market in all asset classes, not only in stocks and crypto, but also in bonds. And that makes this correction here a lot more challenging than we've seen in many years before. It's also the lengthiest correction that we've seen since 2009. The Fed always intervened on market drops, and markets came immediately back. This year is getting much longer in the tooth, and it's a lot like what we saw in 2000 when we had this big tech bubble coming about, and it's breaking down, and that's what we're seeing now with a lot of individual stocks and, of course, massive drawdowns in the Netflix's, Facebook. So it's not only contained to speculative stocks, but also more broad-based stocks. Now we're getting to a very interesting point because a lot of what has happened, obviously, is yields have risen dramatically since last year. Last October, November, I put out this chart about the 10-year yield, which had a technical pattern. It started off this at 1.59%, and the technical target was 3.2%. And guess what? We hit that precisely yesterday and reversed.
Yes.
I mean, it was amazing. I mean, I'm as a technician, I mean, I love when technicals come out to play perfectly. And the big question for me was it going to reverse there? And it did. So far it has, but obviously stocks are still under pressure at this very moment. But I think it's absolutely critical what happens with this, because in 2018, the stock market fell apart when the 10-year hit 3.2%. Why? Because the debt construct had already gotten so large that markets could not handle it. And obviously what happened was markets dropped, then the Fed flip-flopped and cut rates in 2019 with unemployment at 3.5%. Since then, we've added over $8 trillion in debt. So there's no way mathematically the system can actually handle these type of yields at this point. That's why I think this whole notion that the Fed is going to raise rates 10, 11, 12 times to get the Fed funds rate of 3% is not realistic, simply because from a mathematical point of view. That's where I'm at.
So how far do they go, do you think?
Well, if you look at the long-term trend, it's been a show of lower highs and lower highs over the last 30 years. And the reason for that is because of precisely of the debt. So each time they raise, they get to a point, everything falls apart, and then they're forced to cut again because a recession comes about. And the long-term trend on that chart basically says, 1.75, maybe 2.25 or something is the most they can get to if they're lucky. That's the trend. And they have to prove to me that they can do anything else beyond that. So my view is what the market needs right now to stabilize is to see a sustained reversal in that 10-year from below 3.2%. The Fed may be meeting them somewhere in the middle and then stop and pause. And that would be kind of the pivot, and that would be maybe the bullish outcome out of all of this. But it's critical that happens fairly quickly, otherwise we continue to have downside risk.